Yeah, there's a lot going on right now, Kyle, that's for sure. And it does seem like security tokens, they have a window of opportunity to ride on all this hype that's going on. We know T0 has got a lot of partnerships in place, and there's a few upcoming listings that we heard about, though we don't know when. And we know many new marketplaces like Securitize and Archax, they've been approved. So hopefully some listings more from them as well. And I know a few more listings are coming to international exchanges like Merge. So it feels like a lot of drip, drip, drip. And then, a waterfall feeling will come into effect. And you know what they say, when it rains, it pours. So here's hoping.
We can only hope so. But in the meanwhile, let's take our time here to discuss one of security tokens' implications on a specific asset class, one that has historically been one of the most lucrative in the world and most coveted to get access to. I'm talking, of course, about the venture capital asset class.
Yeah, I think many of our listeners are familiar with venture capital, but I do think it's important, of course, that we give a background and an overview of this typical structure just in case they aren't.
I think that's a great idea, Herwig. How about you take us to school?
Okay, let's buckle up because we're going to travel back in time, really not that far actually, because venture capital is also seen as one of the newest asset classes in the world. So it really only emerged as a concept and business in the 1970s, only 50 years ago, people. So it was, of course, made prolific by the incredible returns created by the early VCs of Silicon Valley, which invested in semiconductors and chip technology, which of course flourished under the hardware and computer revolution. So the model was born and proven. Invest in companies early that have big potential and reap the rewards when they go public, which many VCs did during the 1990s dot-com bubble. And this success drove others with money to seek out the same returns.
Now, the model itself wasn't as simple as finding and investing in early stage companies. Typically, it involved an investment manager, known as a general partner of the venture capital fund, who has experience in the specific industry and some financial knowledge in order to be able to source, identify, and invest in the right opportunities. Interestingly enough, the success of the individual investments was extremely low, with a few companies out of 10 or 20 resulting in all the earnings or returning all the earnings. In fact, it was so low that for many VCs, it was difficult to reach the same level of returns if they get a home run, which is why really only a few dozen VC firms or so actually run the industry today. It's because all of the dollars want to be placed with them since they have proven that they are investors in an asset class that is so young and they're successful at it.
Right, so let's dive a little further in that model a bit. The general partner, or many times several partners, they're essentially the CEO of the fund, right? The same implication. They are the visionary that runs the business of finding and investing in private, high-growth companies, and who the investors are essentially backing. The fund, which needs money for the general partner to deploy, raises money from investors known as limited partners or LPs. So historically, and this fundamentally hasn't really changed, the business model has been the same for all venture capitalists. They charge 2% per year as an asset management fee, and then they charge 20% of the gains. This changes with the first-time fund managers or with proven experienced fund managers sometimes, but ultimately that value comes from the fund's ability to create returns. So the important thing to take away from this is that a limited partners, the investors are typically investing in something where they will pay a small fee annually until they get their proceeds typically towards the end of the fund. And since it can take sometimes between 8 to 10 years to invest, grow, and then IPO or sell a portfolio company, most LPs recognize venture capital as a long-term investment. And on top of that, since there is no marketplace for venture capital funds and funds are actually kept as private companies, investors have also recognized this as an illiquid asset class.
So what you're saying is that most limited partners investing in venture capital funds are aware that they may not see the returns for almost 10 years and that they won't actually be able to easily trade or sell these interests in that time period?
That's exactly right. And our listeners who understand security tokens are probably already connecting the dots that the security tokens can obviously massively disrupt venture capital as an asset class.
Yeah, I think we can get into the implications now that everyone listening understands the asset class. So there are more complicated things we could get into, like managing capital calls by GPs who don't need to collect $100 million up front from LPs. We're getting into the waterfall payout structures and all that kind of stuff. So we're going to dig into that in a little bit. But first, let's start with one of the structures that we just talked about. And that's liquidity. So simply due to this factor alone, many investors shy away from this asset class. Other asset classes like real estate and similar funds like private equity also have long hold times, so it's not unusual. But the reality is that you need risk appetite and capital to consider making an investment into a venture capital fund. If a security token could create access to liquidity for LPs, more investors may consider participating due to the diminished risk presented by the illiquidity.
And I think that leads into access, which is another big problem. Getting access as an investor to a VC firm is very difficult. Doesn't matter who you are. Similarly, the way VCs need to source, diligence, and identify portfolio investment opportunities, LPs need to do the same with VCs. However, venture capital has already notoriously been difficult to access for capital as an entrepreneur, and as a fund manager, it's even more difficult to find LPs. Now, of course, with a website and crowdfunding technology, anyone, regardless of their wealth or access, could potentially learn about and invest into a venture capital fund and get equal exposure just like everybody else.
And more access and interest from investors means more capital flowing into ventures, which means more dollars flowing into startups ready to change and transform the world. You can make an argument that security tokens are actually accelerating innovation as a result of this.
You absolutely can make that argument, Kyle, and it will also bring a lot of new types of investors to help take advantage of this huge price disparity that exists between early stage private startups, up until they IPO on a public market. Hedge funds and PE funds could also start trading and participating in this asset class more actively. As we mentioned, retail investors and high net worth individuals can start to access and play in this asset class, And before getting direct exposure to this was nearly impossible. So maybe you can tell our listeners about, also some of the direct and indirect economic rights for venture capital as a result of security tokens, Kyle.
Absolutely. So now in the traditional venture economic models, you traditionally see some sort of waterfall structure where different tiers of capital are paid out as the fund returns capital. Essentially, the distribution waterfall would determine the order in which the returns are paid out. And while the waterfall can vary depending on the fund and the investor rights, there tend to be those four categories. The first and foremost is actually returning the initial capital, where the initial distributions would go right back to the investors to pay for their initial investment into the fund. Once they've been paid back their initial investment, they'd also receive 100% of the returns until they receive the preferred return on their investment. This is something that usually they target at the beginning. That was what they were pitching to the investors to begin with. Usually the preferred rate of return for this tier is probably approximately 7 to 9%, something in that range. From there, the additional gains will go to the GPs and the sponsor of the fund until they reach their target percentage return. And then finally, if there's anything left, it can then be distributed between the different parties depending on their agreed upon rates.
Yeah, so this is a standard payout for a venture fund. And as you can see, listeners, even just distributing this payout to many different shareholders is a process that could tremendously benefit from leveraging smart contracts and security tokens. Essentially, you'd be able to cut out the middleman from this process, resulting, of course, in much quicker payouts, less fees, more accurate and transparent reporting, things like that. So you could code the agreed rules, for example, into the smart contract and have this process essentially auto-execute for investors in real time as proceeds are distributed.
That's totally right. And it's also interesting to look at the current tokenized venture funds to consider their structures to see if there's anything that we can learn as well.
That's right. We got a bunch of tokenized venture funds already out there. We got Blockchain Capital, Spice VC, Science Blockchain that you covered earlier in this episode.
Yeah, we also have MinerVest in Africa and Andra Capital, as well as many others around the world. But you bring up great examples to use in the case of Blockchain Capital and Science Blockchain, Herwig, which actually have both been reissued as their tokens to address some of those early concerns around distribution payouts. You see, back in the wild west of the blockchain era, back in 2013 to 2017, there was hardly any clarity on these assets, and both Blockchain Capital and Science Blockchain were innovators in this space, seeking to tokenize their funds to raise capital but allow for trading of these LP shares. However, they did not follow the security token route and launched what were essentially compliant ICOs that did not represent any underlying rights to the fund. Instead, they pioneered the indirect economic rights model. In this model, the fund would use each liquidity event to buy back those trading shares of the fund and remove them from circulation. In this scenario, they would be reducing the supply of the shares and in theory would be increasing the price because the demand would stay the same. In this way, they could generate returns for their investors while not offering direct exposure to the fund's portfolio.
Yeah, I mean, this is definitely another great example of a new way for VCs to create indirect exposure to their fund using security tokens, because this buyback model normally would simply not be seen as a best practice in the VC world.
But despite this early model, we've come a long way since then, and both funds have decided to scrap that model and the self-issuance process, and now they work with Securitize as an issuance platform. Now, these tokens are structured as direct economic rights vehicles, which give investors that direct access to the fund's returns on its portfolio. I'm not totally sure on the exact waterfall structure for the assets at this time because that information is not publicly disclosed, but presumably the dividends are paid to investors as the firm has liquidity events paid directly to their wallets through Securitize's platform. That's why it's so important, as I mentioned before, to upgrade your shares as the Science blockchain investor because you will not be entitled to those direct returns with the prior SCI token. You need to actually upgrade it and get rid of those original tokens you had to get those new ones to claim your rightful ownership of the fund.
Yeah, and this model makes so much more sense and is simpler than this kind of weird workaround. Again, stick to best practices, right?
So with security tokens and smart contracts, we make that distribution process so much more efficient, but it also allows us to embrace securities laws by providing investors with the proper protections and rights that they are entitled to. That's what's important about security tokens versus other tokenized vehicles. In other models, issuers are trying to remove any of the underlying asset from the investment vehicle, which in turn strips investors of any of the value that they're actually paying for. It doesn't make sense as an investor to have to rely on hype cycles and the fear of missing out just as your only way to make money on an investment. If you're investing in an early stage product, whether it's a company, a fund, or something totally different, you should absolutely have some stake in the future success of the company or fund. And with the ease of security tokens, we can make that possible for investors and assets all around the world. It's actually very exciting to think about the opportunities presented by security tokens, and venture capital funds are not unlike the rest. But that's about it from me on the topic of tokenized VCs. Is there anything else from you, Herwig?
Nope, I think we can call it a wrap. So thanks so much, everyone, for listening. Please send in any questions or feedback to us on Twitter or LinkedIn, and be sure to get the latest trading data and news at stomarket.com. And if you are on Clubhouse, join us this Thursday at 5 p.m. for the breakdown of the show like we do every week. And if not, I'll catch y'all next week on Tuesday for episode 86.
Thanks so much for listening.